Welcome to this live webinar on FX Street. I want to welcome you to this webinar on trading breakouts. This is a part of our limit order series where we're going to go through and talk about the various order types. Many of them you may be familiar with, and we'll get into different types of strategies and how these order types are associated with these strategies. And the point here is that there is that potential to earn positive slippage by using certain order types, and we'll get into that here in a moment. And so we're going to highlight those strategies that tend to use those types of orders which have the tendency to bring positive slippage to your account. And so again, my name is Jeremy Wagner of Daily FX Education. And so I'm going to take about 5 minutes or so, talk about the order types. Then we're going to go out into the charts and take a look at some breakouts. This is the second part of a breakout series that I'm doing. 2 weeks ago, I was at this very same place. We talked about breakouts and the market conditions that tend to yield the breakouts, and we highlighted the Aussie yen currency pair at that time. And so I do have that chart prepared. We're going to follow up to what I went over 2 weeks ago very briefly, and then take that a step further and talk about breakouts and the benefits of trading breakouts and how you can identify some breakout trades. So any questions you have on anything that I'm going over is free game. Simply type those into the chat box, and we'll get to those here in a few minutes. Also, if you are familiar with trading breakouts as well, and if you think there are some out there on the horizon, simply type those in and we'll check those out as well. So the three order types that I'm going to be going over are going to be the market, the stop, and the limit order. And then last week we went over the identifying the breakout conditions using Bollinger Bands. So I'm going to use the Aussie yen chart and highlight what we went over and what the result was of that trade. And there is another potential looming trade on that Aussie yen as well using the Bollinger Bands. I'm just going to take a few minutes and review that. And then also we're going to get into identifying the breakouts using pure price action. If you need an indicator on the chart, then price channels is another name for the Donchian channels, could be an indicator that you could add to that chart. So let's go over the different order types and how it fits in to the breakout style of trading. The first order type are the market orders, and those are the types of orders where you want to get into the market right now. So you've got that execution guarantee where you're saying, I just want to get in at the next best available price. So you could get executed at the requested price, the price that you clicked on the dealing station. You could get a worse price, which would be negative slippage, or it's possible you could even receive a better price, known as positive slippage, when you do a market order. So you've got the whole gamut of potential outcomes when you're executing at the market. Now, stop orders, this is placed at a price level less favorable than the current market price. So, for example, if I'm going long the dollar yen, I'm going to place a stop at a price below where the current market's at because I'm going to want to sell at a worse price than where I'm at right now. Sell at a lower price in order to get out of that long trade. It becomes a market order when it's triggered, and I could receive that requested price. I could receive a worse price, negative slippage. And it is rare, but it is possible also to receive a better price on the stop orders as well. Limit orders, this is an order that gets placed at the current price level or at a price level that is more favorable than the current price. It's also known as the take profit order. It could be a limit entry order. So if I want to go long the market, but I want to go long at a more favorable price, that means that I want to go long at a lower price. So it could be a limit entry order. It could be a limit take profit order. And the good thing about using limit orders is that you get executed at your requested price, or you could also get executed at a better price. So, for example, let's say I want to go long. So I place a limit entry order below the current market. And if price were to spike down and there happens to be the potential for positive slippage because liquidity in the market is fairly thin, then I could actually get executed at an even lower price than what I had suggested or what I had anticipated or desired, which means I'm getting in a buying position at a lower price than what I originally wanted. So you do have that potential for positive slippage on limit orders. There is not that potential for negative slippage. Therefore, when we're out looking at strategies and when we're out making our trading decisions, one way to help stack the cards into your favor is to try to use limit orders as much as possible. Because, for example, scalping or day trading, if you're out there looking for 10 or 15 pips, use a limit order on every trade. That way, if you happen to get a quick spike in the market, then your 10 pip gain that you were trying to ascertain may slip into 11 or a 12 pip gain. And when you're talking about day trading or scalping, that could be a huge factor that could contribute to your account balance. So today I'm going to be talking about breakouts. Now, why are breakouts important? Just the fundamental aspect of breakouts. And I've got two things highlighted here. And if you really take a minute and think about this, these are a couple of things that are very important to a trader. Number one, you've heard the old adage, the trend is your friend until it ends. Therefore, always trade in the direction of the trend. Well, when you're trading a breakout, essentially you're letting price prove to you when that trend is resuming. And so you're letting price prove to you that it's going to want to move up to a whole new level. And I grew up in Indiana, and so Indiana is known for, here in the United States, for basketball. And so there's this basketball game out there. It's called, horse or pig. Basically, it's just a shooting game where, you have two opponents. The first person shoots. If they make the basket, then the second player has to shoot from that same location. So you're trying to do trick shots. You're trying to find a way to make a basket where your opponent is not going to be able to make that same type of basket. But at the end of the game, in order to win the game, you've got to be able to prove it. So if you get to the last letter in the game of horse and you've made the basket, your opponent misses the basket, well, now you got to come back and you got to prove it, meaning you got to make the basket again. And so that's the great thing about using breakouts, is that the market, just pure price action alone, is indicating to you that it is wanting to trade at a whole new level, at a different level that it hasn't traded before in the past. Now, the second great thing about trading breakouts is that it can keep you out of losing trades. And so what I mean by that is, let's say you're wanting to trade a breakout on a daily chart on the Australian US dollar going long. And so your idea is, hey, if the Australian dollar breaks out to a brand new high, then I want to be in this trade going long because prices are trading at a level that they haven't traded at before. Okay, so that's your idea. Now let's say that you were completely wrong on your idea and prices never made it to that new high. In fact, prices reversed and went straight down from here. Although you were wrong on your idea, meaning you thought prices were going to trade to a new high, although you were wrong on that idea, you stayed out of a losing trade. You never got entered into the trade because prices never broke out to that new level. And so as a trader, finding winning trades is important, but also staying out of losing trades can be arguably just as important in protecting your capital. So the action points we want to take away from today is that we're going to be talking about breakouts, and the important thing to do is to use and utilize limit take profit orders on your breakouts types of trades, and then that way you are setting yourself up for that potential positive slippage. All right, so let's head out to the charts. There we go. So this is the daily chart on the Aussie yen. And there was a question, Boyke saying, is there really slippage in Forex? And absolutely, especially in a fast-moving market, it could happen at any time. Here's a couple of conditions where there's a tendency for slippage to occur. Number one, news trading. Last week we had the non-farm payrolls that was released. And I don't know if you've ever tried to go out and trade major news events like that. Liquidity dries up. There's not a whole lot of liquidity out there, and you got a lot of people grasping for that liquidity. What that means, in simple terms, is that, let's say, I think Walmart's a fairly global company. I think Walmart or Carrefour are the types of, businesses that are around worldwide. So I think everybody's going to know when I say Walmart or Carrefour. But let's say that Walmart or Carrefour is selling big screen televisions for $100 a piece. However, when they place that advertisement, there are going to be a ton of people that are going to want that big screen television for $100 a piece. So the demand for those televisions is going to be great, and then the supply is going to get dwindled down very quickly. You're going to have a lot of people fighting over a few amount of cheap televisions. And so that's what happens around news events, is there's not a lot of large banks providing liquidity, and then all the retail players, the players like you and I, are out there grasping at straws and trying to grab onto what little liquidity tends to be available. So news events, times when there is a low liquidity in the market, that could be around major holidays, like around the Christmas or New Year's time, which we just experienced about a month ago, or even if there's bank holidays that tend to fall in the same time period, and just none of the large banks are really out there trading, or none of the big traders are out there trading, that there tends to be some reduced liquidity and price gaps where you tend to get the slippage. Another thing too, which maybe you haven't really thought about it, but I'm sure you've experienced this, is weekend gaps. So the market, the trading closes on Friday afternoon, trading resumes on Sunday, prices open at a drastically different level than where they closed on Friday, and so that's a potential where you could receive positive slippage. As a matter of fact, that is one strategy that you could utilize in trying to capitalize on positive slippage, is actually trading a weekend gap. I'm not going to get into that today, but if you are interested in more information on that, I can send you a link and get that out to you. So today, what I want to go over here is just a brief recap of what I went over the last time, and a trading idea that was developed on the webinar last time. I'm going to use Bollinger Bands. I'm going to use a 50-period moving average and one standard deviation. And so these show up on the chart. And I'm going to zoom in here, and this big red candle right here did actually trigger a short trade. And at that point, I was suggesting anytime we get a close above the upper band, below the lower band, would be a trigger entry. And you can see we got triggered into this trade, and then we got stopped out on it. So your stop would have been just above the high here. Well, a couple of days ago, we just moved up above the upper band. So according to the strategy I talked about last week, this would have been a signal to go long on the close of this candle, and then you would place your stop just below the low of this candle, so of the candle that generated the breakout. So that would be about just about 100 pips of stop loss, so you would be looking for 200 pips of profit potential. Prices are still in that same area where that signal would have been generated. So if you wanted to go ahead and go long the Aussie pair, the prices are in that same vicinity. You could maybe even tighten up this stop a little bit and place it just below the low of these candles. Now when you tighten up your stop, there's a balance out there. So yeah, you are risking less pips. However, by having a tighter stop, you are also increasing the chance that your stop's going to get hit. And that's okay in this situation, because if my stop gets hit, then that means this trade idea really wasn't that strong of a trade idea anyway. Whereas if it is right and it starts to take off to the upside, well then, you know what, I risk a little bit, and I captured twice my risked amount. So there's the Aussie yen and a potential looming trade. If you're interested, on a scale of 1 to 10, I'd give that maybe a 5. It's not anything that I would fall head over heels on. If I were to take this trade, I'm not taking the trade, but if I were, I would risk probably 1, maybe 2% of my account capital on this trade idea. All right, let's take a look at the euro dollar. Let me get rid of these Bollinger Bands. And this is a daily chart. I was mentioning right before I went on the air that I do think we are approaching some significant turns here on the euro dollar. And so there are some signals, and I just want to share these signals with you, that are suggesting perhaps a long trade. but I'm not real excited about those long trades on the euro dollar because this black line here, which has been supporting prices since June of 2010, finally broke through it. What was support tends to become new resistance. That's a very important concept when you're thinking about breakout trades, because if you miss the breakout, you could always get back in on the retest where that former support becomes new resistance. So that's what we saw here. That's also what we saw up here as well. Let me dial into a smaller time frame chart. This is a 1 hour chart, and you can see that here was that long-term trend line from June of 2010, this dotted line right here, and you could see it just poked right above it and returned back below. So there is some overhead selling pressure. Now, we did have a significant down move here, and so I like to look for the 61 to 78% retracement levels. And so this is the area where I think prices are going to stall out in the mid to upper 3700s. So that's about 100 pips above where we are right now. You can see here that if you were trading breakouts and if you were looking for horizontal levels of support and resistance, that around this price where we're at right now, this 36.89, 36.88, was horizontal resistance. Prices broke through this a couple of hours ago. It broke through this downward sloping black line. So a trader looking at this might be thinking, hey, we have busted through 2 levels of resistance. There's got to be some type of strength behind this. And, that argument is very possible. If somebody were to say that to me, I would say, yeah, that is a potential legitimate argument. So somebody looking for a breakout trade might look to go long on that breakout. I would caution you that if you were looking at that, again, I think this thing is eventually going to stall out in the mid to upper 3700s. So this is when you're going to want to look for a tight stop. And how you would trade it is, the breakout 3788 area, a stop just below this level here. So that's about 70, 80 pips worth of stop. So you want to have twice that as your take profit level. So that would be a take profit level of around 150 pips. So 150 pips from the current level would be in the low 38s, like 38.10. And so to me, this trade setup again isn't that exciting to me, because although I do think prices are going to move up, I'm just not convinced it's going to make it all the way to the 38.10 level. Perhaps to that 38.50, 38.75, but I'm going to want to be well out of a long trade before that occurs. So let me touch on one more trading idea. And again, looking for levels of horizontal support and resistance. If you can just eyeball the chart and take a look at those levels and look for a breakout of those levels, that's a very simple way of trading an effective strategy known as breakouts. Now, if you want some assistance, and if you want an indicator to help rely on identifying looming breakouts, let me share with you the Donchian channel. So it's also known as the price channel in some of the charting softwares out there. Basically, it's going to take the highest high price and the lowest low price over the X number of periods. So in this case, it's defaulted to 20. Now, since I am looking at an hourly chart, you've heard some traders use the previous day's high and the previous day's low as a breakout type of strategy. So in this case, it's an hourly chart. I'm going to use a 24 input value. Now, in Daily FX Education, my colleague Tom Long, he also uses price channels quite a bit, and he will use a 55 period input value. Is anyone any better than the other? No, it just depends on what your outlook is on the market. By using a 24 period input value, I'm saying, hey, I'm looking for prices to break above the previous 24 candle high, which is this upper line. I'm looking for prices to break below the lowest value of the previous 24 periods, which is this lower line. And so what you would simply do is identify the direction of the trend. The pound dollar has been in an uptrend on the daily and on the 4-hour chart. And so therefore we would look for a break up above this higher brown line right here. And so we got a temporary break, and now prices are starting to move down. So if you took that trade on the break of this brown line, you would place a stop below the swing low, which would be down here, which also happens to be where this lower brown line exists, the lower Donchian channel, the lower price channel. And then whatever that distance is, take twice that distance as your take profit level. That way you're incorporating the limits and into your strategy. And so that if prices do get close to that limit, you got that potential for positive slippage. All right, let me take a look at some of the questions here. GZN says, Jeremy, some experts say it's better to use buy or sell stops as entries, largely because you only get triggered if the market is going your way. That is indeed one of the benefits of using a breakout type of strategy. You could watch the market, you could enter in at a market price, or you could use a buy or sell stop in order to enter into the market. Now, the risk associated with using either of those as your entry mechanism is that, yeah, you do have the potential for negative slippage. But that's just the nature of the beast. However, in order to take advantage of the limit orders, utilize a limit take profit order as your exit. So there's a couple of ways that you could trade breakouts. One of them is that you could manually trail your stop. The other method is that you place a limit take profit order out there. And so that as prices approach your take profit level, if they happen to gap through that level, then you have the potential to earn the positive slippage. And Mr. Volker, welcome. Welcome to the webinar room. There is so much slippage that there is no guarantee your limit order entry will get filled. That is the possibility that you might experience. Is that it is available on the liquidity available in the market. So if you get a spike and prices, let's say I've got a limit order up here at 61.50. Let's say I'm long in the trade. I got a limit take profit order at 61.50, and let's say prices spike up there, touches 61.50, and then immediately turns tail and runs back below. And then the amount of liquidity available at 61.50 is so thin that not everybody is able to get executed at that price. That is a very real risk in the market. And so, again, what you're saying is I don't want this price to get executed unless it's at 61.50 or better. In this case, 61.50 or higher if I'm going long. And so it is possible that prices may get close, but there's not enough liquidity to fail. That would be that would be a parallel to, let's say prices got to 61.48 and then turned around on me. So it's the same thing. It's the same type of risk that I take on every day. And so it would not hurt my feelings if prices did not get filled, because that was what my whole game plan has been all along. As a matter of fact, let me share with you. I'm going to change a chart here. And this is a trading opportunity that I was looking for earlier this week. Okay, this is the Aussie Kiwi. It really has nothing to do with breakouts. But you can see here, this is Friday's activity on the Aussie Kiwi. And I noticed on a daily chart that we approached those levels last week. It also happens to be where this high is back in early January. And so I'm like, hey, this looks like a good short opportunity on the Aussie Kiwi. And so what I did is on Sunday on the open is I placed an entry order to go short at 32.10. And you can see here I missed it by 5 pips. I mean, it was a nice move to the downside. I missed it. And you know what? It's like, dadgummit, 5 pips. You know, I missed out on 100 pips for 5 pips. But that's just a part of trading. It comes with the territory. You're going to have that. And so as a trader, what you're going to want to do is you're going to want to get those emotional situations under your belt, get used to experiencing them, so as they happen in the future, because they will happen, as they happen in the future, it doesn't take a toll on your trading mentality. So yeah, I missed out on an opportunity of about 100 pips because of 5 pips. It happens. Same thing of a limit order. You know, you may go up and you may be within 1 or 2 pips of your limit order. but it happens. So you got to get used to it. That's why it's important that you risk a very small portion of your account capital on your open trades. We have a time limit here, so keep for part 2. Oh, you were talking about the Aussie yen trade earlier. Just showing you different ways that you could use the various ways of trading breakouts. Where do you exit? Again, if you want to incorporate the limit orders into your trading approach, if you're a breakout type of trader, take the distance from your entry and your stop and use twice that as your take profit level. Sorry about that on the attendee list. But actually I have to do that in order to read the questions. Donchian channel seems similar to the Bollinger Band. Yes, they are similar. They have different ways that they get calculated. Donchian channels is a simple calculation based on the previous price highs, previous price lows over the X number of candle periods. And the Bollinger Bands has a volatility filter built into it. So as volatility expands in the market, the Bollinger Bands are going to expand. As volatility contracts in the market, the Bollinger Bands are going to contract. And so what that volatility means with regards to the Bollinger Bands is essentially the length from the high to the low on the candle. So the more large candles you have, the greater the volatility you're going to experience. The smaller the candles are, the tighter you're going to see on the Bollinger Bands. Let me go ahead and these are the Donchian channels, but let me go ahead and add the Bollinger Bands so you can get a better look at that. And this is just the standard 20 and 2 setting. And you can see here that as we start to get many small candles together, you can see these Bollinger Bands begin, try saying that 3 times fast, the Bollinger Bands begin to contract. And then, boom, we get an increase in volatility. The candles begin to widen out, and then the Bollinger Bands widen out. Jess says, can you please explain the limit take profit? Is it the same as a setting to take profit target as one's putting on the entry order? Yeah, take profit, when you are establishing a take profit order on your platform, that is essentially a limit order, a limit exit order. So you could have a limit entry order, you could have a limit exit order. Essentially, a limit order is an order placed at a better price than where the current market is trading at. What are your Donchian channel settings? 20. That's the standard input value that comes in when you, if you're applying Donchian channels to your chart. And in this particular example, I'm using an hourly chart. And so on an hourly chart, I would use a 24 period input setting. The reason for 24 is because that way it's an hourly chart. I'm taking 24 hours in a day. I'm essentially taking a 24-hour high or low. So in the case of the pound dollar here, I would be breaking out or going long on a breakout above the 24-hour high, or a break below the 24-hour low. So it's a one-day high, one-day low, essentially. All right, let me go and check out, let me know if you see any breakouts looming on any charts that you're looking at, and we'll check those out right now. Jez says, is there a possible breakout on the 4-hour Aussie dollar chart? So let's see. Let me change the chart here to the Australian dollar 4-hour. And when I'm out looking for trades, a lot of times what I like to do is I like to start off with the daily chart. And so here's the daily chart on the Aussie dollar. And basically what I'm doing is I'm getting a feel for the market, a flavor, a mood, a sentiment. And so we can see here that the Aussie dollar, without really dialing into what each of the candlesticks are looking like and support and resistance, without dialing in, you can see that this thing is in an uptrend. Prices tend to be moving higher. And so that's one thing I'm going to be keeping in mind here, is that it seems as though the daily price activity is wanting to move higher, although it is struggling to make a new high here. So when I dial down to this 4-hour chart, then I can start to look for, potential breakouts. Now the thing on the Aussie dollar is the longer term trend on the Aussie dollar has been to the upside. But you can see here, we have yet to break up above this high at 102.50. We're about 150 pips below that level. And so if prices are successful in turning down from here, then this could possibly be the start of a trend lower, because I now have established a lower high. So going short the Australian dollar at this stage of the game would be a little bit riskier. But yeah, this is a 24-hour channel. Since we are on a 4-hour chart, again, my colleague, Tom Long, he likes to use 55 period input values. 20, 24, it really doesn't matter what input value you want to look at, but we're in a high risk zone right now on going short. So in order to make this a more conservative trading signal, moving out to a 55 period would be a way to help me identify more conservative signals. And so at that point, a break below this 98.65 area is where you would start looking for short trades on the Aussie dollar. Now, as these 4-hour candles click off, this lower band on the Donchian channels is going to start creeping up. As we start to break above this area here, this band is going to start to move up on me. So it's possible my entry to go short the Aussie dollar may start to tighten up and get closer to where the current price action is, but time will allow that to happen. Based on the current chart that we're looking at the 98.65 as our level to go short, or a level to go long. I would feel more comfortable if it breaks above this high right here. If you just want to take it just purely based off of the channels, again, a conservative signal is going to be this 55 period channel. A more aggressive period is going to be the standard input setting of 20, and we would be right on top of an entry going short. And then in that case, use a swing high, which is around the 101.90 level as your stops. You got about 100 pips of stop on this. You'd be looking for 200 pips of profit. Boyke says, do you prefer limit orders to market orders? In certain conditions, absolutely. So, for example, I do like to use limit orders. I use limit orders on probably 80 to 90% of my trades. Now, I will move my stop, especially if I'm looking for a fairly large move of several hundred pips. I will still put my limit order out there, but I will also move my stop in order to lock in some profits along the way. But yeah, as it gets close, you just never know what might happen. And if the market's going to want to give me an extra pip or two or 10, depending on what's going on and what happens, I'll surely take it. You can't take advantage of it if you don't have your hand out and asking for it by using a limit order. That's the way that I look at it. So probably 80 to 90% of the time, I'll use limit orders on take profit levels. As far as exiting the market at the market, so let's say, for example, I don't do a lot of scalping or day trading, but I will. I like to use the Aussie Kiwi. And so if I am looking for, let's say, 15 pips on the Aussie Kiwi, then I will still place a limit take profit order out there. But if I decide that, it just isn't developing the way that I thought it was going to develop, then I may close it out at the market. But I am going to have a limit order out there, and then sometimes prices may not make it to my limit order. I may not like the price action that I'm seeing, and I may, with my discretion, close it out at market. Terry, a very good question, or actually Jez, let me get Terry first. Which is preferred for Bollinger, the 50 and 1 or the defaults like the 20 and 2? Now, I talked about that on the previous webinar, and as far as with any setting, Donchian channels, Bollinger Bands, stochastics, MACD, RSI, what is the preferred input values? And the answer to that question is it really doesn't matter, because whether you're using a Bollinger Bands of 20 and 2 or 50 and 1, it tells you about the same thing. The difference is what is your take on the market? Do you want a shorter term outlook on the market, or do you want a longer term outlook on the market? Now, there is a give and take by having a shorter term outlook on the market. What you get by having a shorter term outlook on the market and using a 20 period simple moving average on Bollinger Bands, what you receive are quicker signals. What gets taken away from you is that the signals you receive more false signals. Whereas if you expand it out and take a longer term look at the market and use a 50 period setting on the Bollinger Bands, what you get are less signals, but they tend to be a bit more reliable. A bit more reliable doesn't mean they all are right and all are correct, but you get less false signals than what you tend to see with a 20 and 2. And then also using the breakouts, the 1 standard deviation is just our trigger to enter into the breakout. For entries, Boyke says, do I prefer limit orders to market orders on entries? I have a mix of them. As a matter of fact, my entries into trades is a fairly even mix between limit entry orders, stop entry orders, and market orders. So I do employ all different types of strategies. One of them that I'm going to be going over in a couple of weeks, in 2 weeks from now, 2 weeks from today, is using Fibonacci and Elliott Wave. And that one is going to have a tendency to use limit entry orders. As a matter of fact, there was one I was considering here on this pound dollar going long. I think it was somewhere around this level here. But that one I was considering doing it and going long, and that was one I would have used a limit entry order on. I decided not to. And then market orders. If I'm out looking for shorter term trades, I'll use market orders with a limit take profit on it. And then, of course, breakouts. I mean, when you're entering on a breakout, it's rare that I'm actually sitting in front of the computer when the breakout occurs, so that's when your stop entries tend to. Just says, why do you use a 55 period on the 4-hour chart? And again, this gets back to the similar answer as to what I gave for the Bollinger Bands. Why is Bollinger Bands 50 versus 20? Which one is better? Which one's better on Donchian channels, 55 period input value or a 20? And again, it depends on your trading style. It depends on your mood of the market. Do you want a shorter term outlook on the market? Do you want a longer term outlook on the market? My colleague Tom Long, who is going to be going over his strategy on the Donchian channels in the 55 period here, about an hour and a half, he takes a more conservative approach to the market. So that's why he uses 55 periods on the 4-hour chart, 55 periods on the 1-hour chart. If you don't have that patience, or you want to take a more aggressive approach and try to sneak in an early entry onto some trends, that's when you would consider dialing down the input values to a smaller number, like 20, 24, something along those lines. And he says, missed most part of this. Can we see the recording? Yes, the recording is going to be made available here once we get finished up. What you can do is I will have a copy of that recording here probably in the next 24 to 48 hours. So you're more than welcome to email me. Let me go ahead and type my email address. It's instructor@dailyfx.com. Also, because you guys are a special guest here to this webinar, contact me after this webinar's end at that email address, and I would be happy to provide you some videos that are different from what was provided to you today, some videos on breakout trading, and some videos on Donchian channels. I'll email the links to where you can view those videos if you send me an email. And also, by being a special and honored guest here to this webinar, I will also provide you guys, you guys who are watching me right now, I'll provide you temporary access to some of the resources that we have available on learning more about the Bollinger Bands, or support and resistance, and price action, and I'll give you temporary access to that as well. Jimmy says, how do I set the Donchian channel on my MT4? I haven't used MT4 in a couple of years. And so there's a couple of ways where that indicator may show up. It may show up by the name of Donchian channels. And so you spell Donchian channels like this. Okay, it may show up that way. It may also show up in MT4 as price channels. I honestly cannot remember what the indicator looks like. But those are essentially the same things, Donchian channels and price channels. So look through your indicator list at MT4 and see if you can find that there. All right, we got a couple of minutes left here. If anybody's got any other potential looming breakouts, type that in and we'll give it a quick analysis here, and or any other questions that you may have. Great question, Boyke. With all these and other different ways of trading, how do we choose which one to do? And what I would suggest is in my opinion, it is beneficial to have several different types of strategies available to trade the market. Just like if you're going golfing, you're not just taking one club with you. You're taking a bag full of clubs. Now, how many clubs do you need when you're going trading? You really only need, in my opinion, a couple, 3, 4 strategies. You know, you can have more than that, and they're going to do different things, but I would suggest at least 2, maybe 3 different strategies. And then the key is knowing when to pull out that club, when to pull out that strategy at the right time. And so that's where breakout types of strategies tend to work in strong trending and sometimes even volatile markets. Okay? So this market hasn't been real volatile lately, but there have been some trends. Although these trends seem to be acting like they're wanting to reverse. That's why on this euro dollar, that's why I was a little hesitant on wanting to trade this breakout going long, because it just seems to me that this trend is wanting to reverse. Partly because of Elliott Wave, which I'm going to be talking about in 2 weeks, and Fibonacci. So that's part of the reason. And so therefore, I'm going to start biasing myself to short trades if prices are successful in pushing up into the mid to upper 3700s on the euro dollar. But the other thing, trend trading, and make sure we want to have a trend strategy. Breakout is a very important, in my opinion, strategy. I think you want to have some type of a breakout strategy. And then, range trading is something. There tends to be some type of range somewhere in the market. And a range could be as simple as trading the Asian session where there just isn't a lot of liquidity and volume. A simple range trading strategy may work out well on a shorter term time frame chart during the Asian session, which is in the evening hours in the U.S., which is nighttime over in Europe, and which is the daytime hours in Asia. So we got a 4-hour dollar CAD. Mr. Volker wants to take a look at that. All right, here's the dollar CAD 4-hour chart with a large wicks on the top and the bottom. And yeah, these large wicks up here, this is one that the daily trend has been to the downside, but notice here that at these tops, let me get rid of these channels. Notice at the tops, we have these long wicks, okay? So if prices are successful in pushing above this high, I might start becoming interested in going long. But ideally, I want to see all these wicks become clear. These wicks represent sellers overhead. So if prices are successful in pushing through these wicks and clearing this 10050 level, I would become excited about possibly going long, because I would have a higher high, and then I would start to bring in a series of higher lows. Otherwise, a short trade below here, 98.30, may be another place to trade. So we are right in the middle of this zone, kind of in no man's land here. Yeah, the long wicks. Actually, I love long wicks. That's something that I like to pick out on a chart because, again, it's a very telling story. Like this guy right here. Look at this wick. You got a very small body. You've got an extremely long wick. And so something like this says, hey, there were sellers overhead. And so as prices push higher on this wick, these sellers are going to start to come out in full force. And that's exactly what happened back here. So I would look for the same type of thing up here as well. If we start to push up into this 10050, going short based on this long wick and trying to get a very tight stop is a good trading opportunity. You might get stopped out 70% of the time, but you can get yourself a very tight stop with regards to the number of pips, and your profit potential is maybe 3 times your risk. And so as a trader, that's what I want to do. I want to be in the position to have a good chance at a good risk-to-reward ratio. And a lot of times, these types of trades can offer you a 1 to 3 risk-to-reward ratio. All right, real quick here on the dollar, or pound dollar rather. Jimmy says, can you replay the pound dollar chart? Where's the support line? All right, well, the support line is going to be here on the lows, so around the 160.20. But if we're trading breakouts, we're going to want prices to break up through a new high. So if you hadn't traded this breakout, if you had traded the breakout that I was showing earlier, that trade would currently be in a loss position. 24-hour. And so again, if you had entered this based on a break above this brown line, well, that entry would have been around 61.04, and we're about 20 pips below that entry. Our stop would be down here where this lower line is on a Donchi channel. If you did not enter into this trade, and if you have not gotten into this trade, I'm not saying you should, but if you're interested in it, then I would wait for prices to push above this new high before going long. All right. Well, it is about 10 till the hour, and I do want to thank you guys for joining me. You guys had a lot of great questions. And again, if you have any additional questions, or if you would be interested in receiving some videos that I've got for breakouts and also on Donchian channels and support and resistance, contact me at that email address. I'll be happy to return you a link with those videos. And also, if you're interested in some of the free resources that we have, you want a temporary password, just let me know as well, and I'll offer that to you. But thanks again, Vicky, for hosting me here on FX Street. And I want to thank you guys for joining me. You guys, we're a great audience. You had a lot of great questions, and I look forward to working with you in 2 weeks at this very same time. We're talking about Elliott Wave, an extremely controversial topic, Elliott Wave and Fibonacci. So there's a lot of things to go through. So Jimmy, send me an email, and then I'll provide you more information on that Donchian channel as well. Thank you guys. You guys have a great day. Best of luck in your trading. We'll talk to you soon. Bye now.